Zeta is extremely undervalued, and now I'm going to tell you why. So this is my 4 dimensions valuation framework. 4 dimensions because it takes in consideration not just a quantitative evaluation, but also your thesis, in this case, my thesis. So my thesis is, and go read my articles on lorenzo2cents.com, my thesis is, in short, that since Zeta has proprietary data, they will get most of the market share they can get with the current product, and they will get to the 10%, if I remember well, of wallet share that the CEO of Zeta is saying they could get to. Okay, so now to the numbers. Normal case scenario. As you know, if you have been followed me, I do 3 cases: normal cases, bear cases, and bull cases, that are, of course, according to my thesis. This is the normal cases that has 50% of probability of happening, and the revenue growth for the next 1 to 5 years, for the next 5 years, is 23%. So I think it's quite conservative, considering that now they are growing close to 50%. Let's see, it's 50% year over year in Q1, but X Marigold, that is the latest acquisition, they are growing so organically 29% year over year. So this means that 23% is quite conservative, I said. I think they can keep growing probably more closer to 30% for the next at least 2-3 years organically. And they are now growing 50% thanks to the acquisition. By the way, they have a history of doing 1 acquisition per year average. So this will not be the last one. And they have also said it very clearly in one of the last earnings call. So most likely they will be growing higher than 30% year over year, at least for the next few years. So 23% for the next 5 years, it looks conservative. Then the next 5 years, from year 6 to 10, is 16%. So I'm pricing in a slowing of the growth. That is not a given. They could easily, I believe, keep growing above 20%. And then after year 11 to 20, and you may wonder why you input the growth 11 years to 20 years if the discounted cash flow is over 10 years. Well, this is counting inside the calculation of the terminal multiples. That is actually the most important thing in this model, because as it is for any growth company, right? Because 80%, I actually have the value here, 78% of the value is given by the terminal value. So it's even more important than the cash flow over the 10 years. Okay, gross margin, it's improving a bit, as it is likely as they become more efficient and they optimize cost. Yeah, and that's it. So they end up to 2% of market share, which tell us that this model is not crazy. Then for the bull case, 26%, so a bit higher growth, but it's still not crazy, very doable. Then 22% for year 6 to 10, and then 15%. So all very doable. I am being conservative with this model. Bear case is actually 18% growth. That is still conservative because they are now growing 15%. So 18% average for the next 5 years, it is conservative. If you have a bull thesis, of course. Then year 6 to 10, 13%, and then 8% for which is nothing for year 11 to 20. So let's now go to the numbers. Here on the, let's say, common panel that takes in account everything comes bottom line after the gross margin. It's more or less quite conservative assumptions. So SGA, of course, is going to improve as they scale more, up to 26%, and similar assumptions are for the bull case. And here, interest, R&D, I have projected, of course, them scaling, but it's nothing crazy that is moving crazily the model. So now the terminal multiples, as you can see, terminal multiple price to sale is 37, 38 after 10 years, which for a company that is still growing nicely, it's very likely and possible. Okay, so to the numbers. Actually, sorry, I said the normal case 38x is for the bull case. Normal case, the terminal multiple is 32x. That is even more plausible. So now to the numbers. And one important thing, I'm projecting 3% of dilution per year for the next 10 years. This is quite aligned with the last year. I think it's around 3%, maybe something more, but they said they are going to keep this under control. So again, 3% is very plausible. Now, as you see here, even with these conservative assumptions, the price for my normal case scenario, so 50% of probability of happening, is 64, which is a 3x from where it is now. Best case or bull case is $133, 7x. And the worst case scenario, again, guys, worst case according to my thesis, it's not worst case in absolute. Worst case in absolute is the heart explode. Worst case or bear case scenario, better said, is you are still making money. So it's plus basically 40% from here. Another important parameters that moves a lot the model is the beta. I say beta in 5 years. Why not beta now? Well, because the beta in the short term, I don't even know what it is now. But the point is that the beta in the short term is moved by volatility and by many things. So I want to know what is the right beta, means the risk perceived by the market for this company when the volatility is cut out. So 1.4, its height means that it's moving 40% more than the market. Just for the record, if I lower this to 1.2, for instance, or 1.1, that is what probably Google or Microsoft could have, this number will double from here, right? So it's quite conservative again. So guys, these are the number. Hopefully this helps. And no financial advice, of course. This number, I mean, this is the discounted cash flow, so it means that this valuation is for now, because normally people ask when it is 2030, in 5 years, when it is this valuation. This is now. But of course, to see this number priced in, it means that the number is discounting exactly the scenario that I've put here. It could happen tomorrow. It could happen in 3 years. And how I use this is just I rarely use this to trim or sell unless the price goes to $150. Then I could trim or sell, because at that point it means that I have less than 25% of probability of making money. But normally I do not use this to sell. I eventually use to increase the position. When it is undervalued, I may increase the position, and when it is more toward the bull case, I may, yes, sometimes trim, but it happens rarely. So guys, if you find this model helpful, you can get it for free by joining the Business Ontology Community. A link in the comment. Ciao.